Welcome to this lesson. In this lesson, we'll be talking about risk management. And in risk management, we are looking at what we can actually make from the market. And then we're also looking at what we can actually lose when we are trading the market. So risk management is very, very important. You have to determine what you will lose and then also determine what you will gain. And what makes a professional trader is the ability to maximize profit and minimize losses. Alright, so when you are trading, you need to know how much you may lose in a particular trade and how much you may gain in a particular trade. This is very important. Alright, so in a risk management plan, we do what we call 1 to 3 risk reward ratio, or what we call the reward ratio. Very, very important. So for example, let's say before we enter a trade, we look at our risk. Look at our risk. And then we look at our reward. Alright, look at your risk, look at your reward. We'll talk about risk management. For example, the market is moving up, and then you're about to enter the market here. Okay, now where is your target for taking profit? Alright, so your take profit, the place where you maybe leave the market or what you will lose. This is risk management. So for every trade you take, you must determine where you will take your profit and then where you will opt out of the market if the market goes against you. Okay, so let's say this is your entry. This is your entry into the market. And let's say this is your stop loss. And let's say this is your take profit. Alright. So when you enter the market here, this is where you want to exit the market, which is your take profit. This is where you put your stop loss. For example, if the market pushes up from here and gets to this place, you will be out of the market. That means you have won the trade. But the market, after entering at this position and the market comes against you and hits your stop loss, then you are out of the market and you close in a loss. Alright, so you must determine how much you're going to lose, how much you are going to gain. That is risk management. And then if you are conscious of risk management, you'll be able to determine when to enter the market and where not to enter the market. So you know that if you are to enter the market in a particular level, the market has to show you that where is about leaving is holding, is a strong structure. So you don't enter the market at a point where it can reverse against you. Very, very important. So you must know your risk to your reward before you enter a trade. Risk management is the only way you can save your account. Because if you don't have knowledge of risk management, you are going to lose. Another thing too, when we're talking about risk management, you should also be aware that you must risk according to your account size. For example, you have an account of, let's say, $100. Alright? If your total account is $100 and you want to take a trade, you are expected to use a lot size of 0.1, okay, per trade. Why are you using 0.1? So that you can be able to minimize risk. Alright? So if the market goes against you for a lot size of 0.1, let me state it clearly here. For a lot size of 0.1, it's called lot size. This is lot size, or you call it volume. For every movement the market will make for you, you are going to get a cent. Of every movement the market moves against you, you are going to lose a cent. But for example, you use a lot size that is higher than your account size of maybe 1.0 lot size. Alright, you discover that when the market moves in profit for you, you make $1. The market moves against you, you lose $1. And because your account size is small, you are not supposed to use a big lot size. You're supposed to use a minimal lot size. Alright? So if you have not watched that video we explain lot sizes, go and watch it again so you understand what I'm saying more here. So risk is golden. When you are entering the market and when you are exiting the market, you have to state it before you enter the trade. Alright? And in risk management, your risk must be smaller than your reward. It has to be smaller than your reward. You can't enter the market, let's say, market moving like this, and then it comes like this, and you enter the market here. For example, let's say you enter the market here. Anticipate that the market is going to move to some of these lows. The market is going to move down to this point. Maybe you feel this is a lower high. And then your risk, you put your risk here. You put your stop loss here. You put your stop loss here. And then you put your take profit here. You take profit here. Okay, and here is your entry into the market. Now look at the risk to reward. You are risking here to gain here. Let me use another tool so that you get it more clearly. And you're risking 216 pips to get 335 pips. Now remember we talk about pips. I will say pips is the movement in price. You see these levels here? For example, look at the level where that market. This is 0.78309. And then look at where we put our stop loss. 8. So from here to here, you minus this from this to get the number of pips. Then you minus this from this to get your take profit. All right. So if you are targeting some of these lows here, and you enter the market here, and you know there's a level above this place, and you put your stop loss here, you are risking more than you can gain. So your risk must be equal to your gain. This is where risk management is very important. That's why you must enter the market at a particular level. You know the price where the price might ultimately return or reverse. So you must determine your risk to your reward before you enter a trade, and you must make sure you trade from the highest point so that you can reduce your risk. The normal stop loss should not be more than 20 pips. A normal stop loss should not be more than 20 pips. When your stop loss is more than 20 pips, then you are risking more than your reward. So the risk reward ratio I want to teach you is risking 1% of your account. So risk to reward ratio. All right, you need to know the ratio of reward to your risk. So at every point in time, you should be able to risk 1% of your account to get 3%. All right. So you should be able to only risk 1% to get 3%. If your account is $100, you should only risk $1 to get $3. Don't risk more than that. So you use your pips to calculate the height of your stop loss, and then the length also of your take profit. It has to be 1% to 3%. 1 to 3% risk to reward ratio is golden. Don't risk more than you can lose, because if you want to stay consistent in Forex, you've got to risk according to your account size, and then be ready to make money according to your account size. So this is very, very important. This is why the lot size you must use must correspond to the your account size. Don't use a 1.0 lot size on a $100 account. You are going to blow that account. So you must understand risk to reward before you take any trade. All right. So mark you, when you are taking a trade, you look at your entry. 3 things you must consider: your entry point, your exit point, which are your take profit levels, and your stop loss. Stop loss is where the market will take you out if it goes against your plan. Your take profit is where you will take you take profit. That means you will make money and say, okay, I've made enough money here, and you leave the market, you close the order. Okay, so that is how you must understand. You want to understand risk management. It is very, very important to every trader. And then also, there are scenarios whereby the market can be moving in your favor. Let's say you enter the market here. Enter the market here. This becomes your entry. And then you put your stop loss 20 pips below. Remember, it has to be 20 pips. And then, okay, then your take profit level, market moves in your favor, to this point here, and then maybe your take profit level is here. And then instead of the market to get to this point, which is your take profit level, it didn't get here. The market instead reversed and then comes back and hits your stop loss. So because you targeted this point and the market didn't get to this point before you leave the market, you targeted that you will make money to this point and then leave the market. When the market moves to this point, you will leave the market, and it didn't move to this point. What do? You have to use what's called a trailing stop. When you right click on your trade on your T4, you see what's called a trailing stop. Then from there you can then enter a comfortable volume where the market can take you out. So for example, you are trading and you see the market moving and unable to break its highs, you should be able to close half of your profit or move your stop loss to your entry. You move this stop loss to your entry, and this is what we call break even. Don't forget this, break even. Okay, so in case the market reversed against you, it will not, you will at least end in small profit. All right, so you can enter the market in a point here. The market is moving. Once the market moves from this point, and maybe you entered and the stop loss was formerly here, your take profit is here. Once the market moves away from this point, you take your stop loss and put it at least 10 pips into the market. So you secure the profits here and then allow the trade to run. So in case it turns back, you won't be at loss. Okay? Alright, so let's go into a live market example. Let me just show you how to put your stop loss levels. Now, alright, so let's look at the live example. So now we see that the market is down, creating this is a higher high, a lower high, lower low, lower high, potential lower low. So we're looking for sales only in this market. So let's see what the market is doing. Let's allow it to do what it's doing. Let's allow the market to do what it's doing, and then give us a potential higher, lower high. So right now we see that the market created a level, but we're not satisfied with the level because it's not out of 50% of the retracement. Take our Fibonacci and let's look at it. It's not up to 50%. So this is not what we're looking for. And then also we can see that there's a level in the market here. Right, a break and a retest to that level. Let's hope to see what the market is going to do now. If it comes back to this level again and shows a sign of rejection, we're going to take the trade. No, market breaks the level. All right, now let's take another look at it from here. Exactly 61.8%, which is 50%. So we want to take a trade from this point. So we see that this is a level that has been created. Okay, it's in line with our 50%. Sorry, it's in line with our 50% rule. All right, of retracement. And then we want to take a trade. So when we want to take a trade, how do we take the trade? We'll enter here. Instantly we are entering the market here with an instant execution. our stop loss will be above this level, and then our take profit will be this low. First take profit will be this low. All right, so this is from here to here will be the stop loss, from here to here will be the take profit. So we'll look at the levels. This is, so our stop loss will be 93000. If we trace it to the back, let me use a longer line so that you can see it. This will be our entry. This will be our first take profit. Okay, so this is the stop loss. This is entry. This is take profit. All right, so we take our position sizing, and then let's put it here. The red side means stop loss, and then take profit. So right now we have entered the market, and then our risk to our reward, we are using 1% of our account to get at least 2%. At least 2%, 1 to 2 risk reward ratio. We are risking 1% to get 2% of our account, but the target is 3%. Why are we doing this? Because we know that the market will create a new lower low. Having created the first lower high, the lower low, this is a potential lower high because 50% retracement, and then we're looking to take our trades to get to the second lower low. So let's play it out and see what the market does. We have look at our levels, entered our levels, and then we'll take the trade. The market is moving in our favor. Market is moving. Market is moving. Market is moving. And then you see the market turning back. Market is moving, failing to break above this place, which are potential target. You see market turning back. But before then, let me show you something. Anytime you see the market failing to break a structure once and twice, and look at this rejection here. Talk about candlestick pattern, look at the rejection here. You know it's going to go back. So what do? You take your stop loss and bring it into the trade and save some profit. So you reduce you break even. So this is what we call break even. You bring your stop loss inside the trade, so automatically you've broken even. So in case the market moves back to this point, you will not be at loss. All right, because this is our target, and the market this is our first target. But for our risk to reward ratio, we say 1 to 3. We're risking 1% of our account to get 3%. We are now trying to get to this 3%, but the market is failing to get there. We have to do what? We break even, so that we don't lose all our profits. All right, so you see that the market turned back, and then boom, we hit our stop loss. So from here to here is our gain, rather than the market reversing and coming back to hit our entry. And when it hits our entry, we are out of the market, and then we lose. Is that okay? So this is how the market moves most of the time. Let's see. All right, it's coming down right now, and then I guess it has hit the take profit here. We hit it here. Let's see. Okay. All right, so we succeeded in taking a trade and the trade created a new lower low. You got it? A new lower low. So this is the previous lower high. This is the new lower low, and then you create another lower high, and then create another lower low. So this is how you should be trading. Your stop loss, your entry has to be intact. Okay. All right. So let's go back to the RMT4, and then let's see something here. So this is our RMT4 platform. You can see that, for example, we are on the Euro USD, the 4 hour time frame. Let's go to the 1 hour time frame, and let's see. what the market is showing us. All right, you can see the market have been pushing up for quite some time now, creating higher highs and higher lows. You see that the market created a high. This high came here, it failed to break it. Look at the previous lower high, was broken and violated. Market pushed down from that level strongly. We'll take our Fibonacci, and then we look at 50% of the retracement. 50% of this retracement. This 50% of retracement. Sorry. Take it from all right, so it went to 61.8%, which is the golden ratio, and you see the market pushing strongly down. So it means that the market retraced after an uptrend and then started creating lower lows and lower high. So this is the previous lower low, this is the potential lower high, and then we're looking for a potential lower low. All right, so this is how you decipher the market, creating these structures, and then you can see that the structure of the market is already going down. So what we expect now is a new lower low, and then a new lower high, and then a new lower low. All right, so I want to take a trade now. It's pretty much too early to take a trade. We would like the market to come back to some of these highs, maybe to form a double top pattern, double top, and then we can look to take the trade down so that we can have a safe place to put our stop loss. So when we enter the market here, we can be able to put our stop loss here, and this above this wick here. Then we can put our take profit here. Okay, so you must understand this very importantly. So for example, let me just take a trade here and let me show you how it works. So this is sell and buy, and we have a lot size 0.01. Our account here is $43. This is too small to trade. It's a risk. So for example, we'll take a sell here. We'll take a sell here. You see the market, the line here, and then we'll put our stop loss. Let's, for example, here. See this line here? It becomes a stop loss, minus 18. Let me show you, minus 25. Look at it. Pips, minus 25. You see it? Pips, minus 25. Then let's put the take profit levels. See it now? Pips plus 30, 356 pips. So we're going to get here. Alright? So this becomes your stop loss. This becomes your take profit. This is your entry, your stop loss, your take profit. Stop loss, entry, take profit. So if the market moves in your direction here and hits this place, we take profit. If it comes here and hits here, we lose 24 pips. That is $2.42. If the market comes here and hits our take profit, we gain $3.56. $3.56 all right, and look at here, you can see that the market's already on. See the sell here, Euro USD, the entry price, the stop loss price, the take profit price, and then you see it, the market is giving us a minus here, meaning we are losing already at 0.09. But once the market moves in our favor, it will enter positive, and then once we are done with the market, we close. Look at the close here, close, or you right click and say close order. Now if you want to take an order, simplest way you can take an order is going to new order here. See the new order here, this place, click on it, and then you look at the currency pair you're trading. So look at the volume. You can set the volume to any of the volume size you want, provided you know your account size and limit. So I can take 0.02, 0.01, and then what type of order is it? Instant execution or pending order? I explained all of this to you in one of the last introduction videos. You type of order, you can use a limit order, you can still use a sell limit, you can use a buy stop, you can still use a sell stop. If you have not watched those videos, you can go back and then watch them and understand them clearly. So you can see at price, for example, we're using instant execution, we can just sell here, but we have to put our stop loss levels. So for example, we want to stay, let's say our stop loss want to be 1.21445. So I put my stop loss here, 1.2144445. The take profit, I'm going to put my take profit here. Let's say this low because of this point here. It's okay, 1.20460. 1.20460. When I'm done with this take profit and the stop loss levels, I say sell, because I know the direction of the market is a sell. So I say sell. Once you say sell, the lines will automatically enter. You see the line here, the red line here. You're going to lose 2.99 cents if the market goes against you, and then the market goes for you, you're going to get $6.86. All right, so this is how you do your risk management. Don't risk more than you want to lose, so that you don't blow up your account. All right, so once you enter the market, put your entry like this, you allow the market to run. Remember, if you are in a 1 hour time frame, every candlestick here is 1 hour, so you have to wait for an hour. You have to wait for some time for the market to move to the downside, to your take profit, or move to your stop loss. When the market stops you out, means the market didn't go your direction, and then you can look to take another opportunity in another market or the same market. So this is risk management. You'll be able to decipher and determine how much you want to lose from how much you want to actually gain. Alright, so that does it for this lesson. Practice. You will understand it better. Alright, bye bye.